What is up, ladder climbers? Antoine Witt here from Elevate to the Unknown, the Way Report and nextgenheights.com. And it is Thursday, February the 5th, 2026, 7:25 a.m. Central, and we are live on the Daily Climb. I got two numbers for you this morning. And these two numbers tell you everything that you need to know about this economy. Number one, $180 billion. That is how much one company plans to spend on AI this year. One company, Alphabet, Google's parent company, $180 billion. That is more than the GDP of 150 countries. Number two, 22,000. That is how many jobs the entire U.S. private sector added last month in January. 22,000. Half of what economists expected. Ain't that something? Ain't that something, guys? One company is spending $180 billion. The whole country added 22,000 jobs. Let me say that again. One company spending $180 billion. The entire economy only added 22,000 jobs. And that's not all. On yesterday, Alphabet crossed $400 billion in annual revenue for the first time. Google Cloud grew 48%. Net income up 30%. On the same day, 300 journalists at the Washington Post lost their jobs. Workday cut 400 more people, and a pharmaceutical company lost $50 billion in market value in one session. The economy is not crashing. It is splitting. You got record revenue on one side. You got record efficiency on the other. The question for every person that's watching this morning, it's pretty simple. Which side are you on? Guys, this is the Daily Climb. Let's look at the data. Okay? Before we look at the data, let's see who's all in the house. Let me acknowledge the ladder climbers. Life of Cam is in the house. The lieutenant, good to see you. Danny's in the house. Ball of energy. I got a chance to talk to Danny last night. Good to see you, Danny. Big Suggs is in the house. Crypto Cakes Cartel's in the house. Charlie Smith, good to see you in the house, my man. We're going to have a good show for you guys this morning. You guys are going to want to see the data. Okay? I know you're going to want to see the data. But before we talk about who got cut, before we talk about the layoffs, I need to show you where the money is going. Because if you understand where the money flows, you understand where the opportunity lives. And yesterday, one company showed us exactly where the money is going. Okay? Alphabet reported earnings on yesterday, and it was the best quarter in the history of the company. Let me walk you through the numbers here. Okay? Check out my screen. Revenue, $113.8 billion, up 18% from last year. Net income, $34.5 billion, up 30%. Earnings per share, $2.82. Wall Street expected $2.63. They beat it by 7.6%. But here is where it gets real. Google Cloud, $17.66 billion in revenue, up 48% year over year. 48%. That is not normal growth. That is a business that is on fire, crushing it. And the backlog, the order sitting there waiting to be filled, $240 billion, up 55% in just one quarter, doubled from a year ago. I want you guys to type 240 if that number just hits you. Crushing it. Type it in the chat, 240. $240 billion in backlog. Okay. Insane, right? Now, here's why this matters for your career. 2 years ago, Google Cloud was losing money. It was chasing Amazon Web Services. It was chasing Microsoft Azure. Nobody was talking about it. Today, Google Cloud is growing 48%. Microsoft Azure is growing 39%. Google Cloud just beat Azure in growth for the first time in years. That means Google Cloud Platform skills are now different from AWS skills. They are not just another option. They are the fastest growing platform in the market. Now, let me give you the number that made Wall Street nervous. The capital expenditure guidance. Boy, oh boy, they spending a whole bunch of money. Alphabet told investors they plan to spend $175 to $185 billion on AI infrastructure in 2026. Wall Street expected $119 billion. They came in 50% higher than anyone predicted. Bespoke Investment Group said it best, quote, there are only 59 other companies in the S&P 500 that Alphabet could not buy with that CapEx alone. End quote. They're spending so much money on AI infrastructure. They're saying that there's only 59 companies in the S&P 500 that Alphabet could not buy with just that CapEx that they're spending on AI infrastructure. Now, I want you to hear how Wall Street reacted in real time, because the number shocked everybody. Okay? Stay with me on this one. The number absolutely shocked everybody. Let's go to Wall Street.
Guy, what's your quick take on
big
this?
Numbers? I mean, and the CapEx guide is clearly not scaring anybody. I'm sure Nvidia's higher as well. Here's my quick take. It is a very strong quarter. And, I guess the rumors of the death of Google 6-7 months ago were obviously greatly exaggerated. But the problem, I think, now is back then you can make a very compelling valuation case. Now, not as much. So at 31 times ish, I'm not saying you got to get out of Google here, but I think you have to be aware that valuation is probably priced almost to perfection.
Unless you look down the pike and you think that additional spend, all that extra spend is going to make the monetization of all the different parts of its business that much stronger.
Well, and you look at the little glimmer you got of it in this last quarter, and again, on a price to earnings growth, so on a PEG ratio, that 30% growth against, a 30% multiple on the trailing gets you to a really actually attractive PEG ratio. I think the numbers that were shocking here, that cloud growth number, and I realize it's not as sexy of a business, but at a time when the cloud competition is heating up, I love to see that 47%. I do think that the dynamic around search, though, their core business, that bogey, first of all, the bar was really high. The bar was 16, which was significantly higher than they were, and they come in at 16.7. The core business, we all know what Gemini seems to be doing. I love the Apple talk. I think this is good for Apple, too, which is also at some point when we talk about the market, we can talk about Apple's defensiveness. But I just wonder what the stock would be doing if they actually came in line on the CapEx.
Crazy. You heard it. Even the analysts could not believe it. 180 billion. Now, the stock actually dropped 2% after hours, even with record results, because investors are worried about how much they are spending on that CapEx, on AI infrastructure. Because here's what the market is missing. CFO Anat Ashkenazah said most of that money goes towards, quote, AI compute capacity and meeting significant cloud customer demand. That is not hope spending. That is demand spending that Google is doing, that Alphabet is doing. $240 billion in backlog tells you the customers are already there. And there is one more thing. Google confirmed this week that Gemini will power Apple's Siri, running on Google's own servers. That deal was worth about $1 billion a year to Alphabet, launching late this month. 750 million people already use Gemini every month. I want you guys to type Gemini in the chat if that number surprises you, or type Gemini in the chat if you use Gemini. I use Gemini, guys. I use Gemini. You don't believe me? This is my Gemini. And I have Gemini Ultra. Okay? All this is Gemini. Fantastic tool. Fantastic model. Now here's the career signal. When you add up Alphabet plus Meta at 125 billion, plus Microsoft at 150 billion, plus Amazon at 150 billion expected, you get close to $500 billion in AI spending for 2026. $500 billion does not just buy software, it builds data centers, it builds cooling systems, it builds power grids, it buys chips, it hires engineers, it hires electricians, it hires construction workers, it hires operations teams. That is where the money is going, guys. That's where the money is going. The money is right there. I'm telling you where it's going. Now, let me show you where the money is not going. And that brings us to 2 case studies. Okay? Stay with me on this next segment. It's going to be a good one. Okay? Alphabet is spending $180 billion, revenue up 18%, profits up 30%. But not everybody had a good day on yesterday. I want to show you 3 stories because these stories tell you that positioning matters more than talent, more than experience, more than your resume. Where you sit in this market determines everything. Okay? Let me tell you a story about 2 companies. Same industry, same market, same day. Completely different outcomes. Okay? Eli Lilly reported earnings on yesterday. Earnings per share, $7.54. They beat estimates by 13%. Zippound sales up 123%. Mounjaro sales up 110%. Those are the BLPs, the weight loss drugs. Their 2026 guidance came in above what Wall Street expected. Stock jumped 7%. And Eli Lilly became the first pharmaceutical company in history to hit $1 trillion in market value. Now, on the same day, Novo Nordisk, the company that makes Ozempic and Wegovy, the other BLP makers, stock crashed 17 to 18%. Roughly $50 billion in market value, gone in one session. Their 2026 guidance, well, sales is declining 5 to 13%. Operating profit declining 5 to 13%. First sales decline since 2017. And the CEO went on CNBC yesterday and said 4 words that should make every worker pay attention. Do not take my word for it. I want you to listen to the CEO yourself. Okay? Check him out.
Analysts were expecting lower sales in 2026, but the guidance that you gave was worse than expected, with sales seen down between 5 and 13% at constant exchange rate in 26. So can you explain and flesh out your guidance?
Sure. We've been explaining this since I've become the CEO of Novo Nordisk, that while the company has a bright future and in many fronts actually we're progressing well, on one front, people should expect that it goes down before it comes back up. And that was the U.S. pricing.
You heard it. It will get worse before it gets better. That is the CEO of a company that lost $50 billion in one session, telling you to brace for more. I want you guys to type positioning if that contrast just made something click for you. Type positioning in the chat. Okay. Now, why did Nova crash? One reason is policy. The Trump administration, most favored nation drug pricing policy, forced Nova to cut prices on Wegovy and Ozempic. One policy decision, $50 billion gone. Many of you guys don't know about that. If you knew about it, people were paying $1,300 for Wegovy and Ozempic in the United States, where it was being sold to European countries for hundreds of dollars, not even hundreds of dollars. So people who were buying this stuff, if their insurance didn't pay for it, they were having to spend thousands of dollars in the United States. President Trump said, nope, we don't need that anymore. We need to make sure that the United States, when it comes down to drugs, we are in line with some of the other countries. We're going to make it affordable. And guess what Wegovy and Ozempic is now? Around the $200 and $300 mark for typical patients paying out of pocket. Okay. Eli Lilly invested in manufacturing capacity. They diversified their pipeline. They are building $3.5 billion facilities in Lehigh Valley. They are hiring in manufacturing, in clinical research, in regulatory affairs, also in supply chain. Crazy, huh? Nova got caught by a force outside of their control. Same industry, same market, same day. One hit $1 trillion, one lost $50 billion. The difference was positioning. And that is the lesson. It is not just about which industry you are in. It is about where you sit within that industry and whether you are positioned for what comes next. Now let me shift to software. Workday. They announced 400 job cuts on yesterday, about 2% of the company. But here's the detail that matters. The language in the filing, they said they are cutting, quote, customer-facing roles that are non-revenue generating. Non-revenue generating. That is the phrase that should stop you guys. This is the second consecutive February that Workday has done layoffs. Last year, they cut 1,600. This year, 400 more. They are spending $135 million on this restructuring. And where is that money being directed? Priority areas, which means AI, product, engineering, and revenue. If your role does not connect to revenue or product or engineering, you are in the efficiency path. The pivot for anyone in customer success right now is clear. Move toward revenue. Solutions consulting, revenue operations, sales engineering, roles where your work ties directly to the money coming in the door. And then there is the Washington Post. This one hits different because this is not a tech company. This is not a startup. This is one of the most important newspapers in American history. And yesterday, they got gutted. Let me show you. Okay. Let me show you how they got gutted.
About 300 employees at the Washington Post are without a job tonight after sweeping layoffs rattled the newsroom at one of the country's most esteemed journalism outlets. The dramatic cuts are reportedly part of an effort to restore profitability for the 150-year-old paper. But one former reporter writes, she now works for The Atlantic, but formerly at the Post. She describes it like this, quote, "We're witnessing a murder," and then took aim at the Post owner, Jeff Bezos. Bezos is the fourth richest person in the world, according to Forbes, with a net worth of about $260 billion. He's owned the Washington Post since 2013.
300 journalists, 1/3 of the entire newsroom gone. Entire sections eliminated. Sports, books, gone. Foreign coverage shrunk. Local metro coverage shrunk. Now, here's the part that should make you think. Jeff Bezos bought the Washington Post in 2013. Bezos also owns Amazon. Amazon reports earnings tonight. They are expected to show over $211 billion in revenue. The same person investing billions in AI at Amazon while cutting 1/3 of journalists at his newspaper. The lesson is not about one person. The lesson is about what the market values. Content that AI can generate or aggregate is being eliminated. Specialized expertise that cannot be replicated survives. If you are in media, build your personal audience. Learn multimedia, video, audio, newsletters. The byline is not the moat anymore. The relationship with your audience is. Okay? And I'm not the only one saying this. The man who ran the Washington Post for almost a decade, Marty Baron, called this one of the darkest days in the paper's history. I want you guys to listen to this. Listen to what's being said about this situation.
Washington Post is laying off 1/3 of its workforce across both the newsroom and its business operations, a massive blow at a storied newspaper that has struggled in recent years to stay profitable and retain subscribers. The cuts reportedly affect more than 300 of the approximately 800 journalists in the newsroom and include eliminating its sports desk and books section entirely. The Post's executive editor said the changes, though painful, were meant to, quote, reinvent the paper for a new era. For more on these cuts and their implications, we're joined now by Marty Baron, who was the editor of the Washington Post from 2012 until 2021. Welcome back to the NewsHour.
Thanks for having me.
You have described this as among the darkest days in the Post's history. What do these layoffs mean for the paper's mission and its ability to continue doing in-depth, substantial reporting?
Well, I think it's important to keep in mind just how widespread these cuts are. Not only the sports desk, the books department, but pretty much the entire arts department, eviscerating the foreign staff, largely eviscerating the local staff as well. So these are huge, huge cuts, and they're going to do enormous damage to the newspaper's ability to cover its community, to cover the country, and to cover the world in all the ways that it should.
You heard at the start of what was said. One of the darkest days from the man that led Newsroom through Watergate anniversaries, through 2 presidential administrations, through the biggest digital transformation in media history. And even he is saying the damage will be enormous. I want you guys to type split in the chat if you see it. Winners pulling away, everyone else under pressure. Type split in the chat. Okay. Now let me zoom out, because these case studies are not random. There is a macro picture that ties all of this together. Okay? Stay with me on this next segment. Alphabet spending $180 billion. Eli Lilly hitting $1 trillion in market cap. You got Novo Nordisk losing $50 billion. You got Workday cutting non-revenue generating roles. You got the Washington Post gutting the newsroom. These are not separate stories. They are the same story. And the macro data confirms it. Okay? Let me come back to that second number that I told you guys about in the beginning of this show. 22,000. ADP, the National Employment Report, came out on yesterday. Private sector added just 22,000 jobs in January. Economists expected 45,000. They came in at less than that, less than half. Here's how the data broke down. I want you guys to watch this real quick. Let's go to the ADP report.
ADP private payroll data just crossing the wire. Steve Leisman's got the number. Steve.
Yes, 22,000, just 22,000, Andrew. We're looking for 41,000. Now, there may be some methodology changes that we can get into. We have Neela Richardson coming up. She'll probably do a better job explaining it than I will. But looking at it by sector, the goods sector up just 1,000. By the way, the estimate was for 41,000. 21,000 on the goods sector. Inside of that, manufacturing has lost jobs every month since March of 2024. The service sector, well, without that, we wouldn't have much going on. And the non-farm payroll estimate for this weekend, or that would have happened this Friday, was going to be 60,000, but we don't know when that's coming out. Looking at it by business size, small business has been extremely challenged since the Liberation Day tariffs. At zero, a goose egg right there. It had a slight gain last month, and it's been negative before that. Medium-sized business doing a little better, up 41,000, and large businesses shedding workers this time around, down 18,000. Looking at it by industry, again, it's the same economy we had before. Education, health services up 74,000, leading the way. Financial services doing well. Leisure and hospitality, not as well as it had been. But look at that construction. I wonder if that's picking up some of the data center construction. But professional and business services down 57,000. Pay gains, pay changes, annual pay, pretty much unchanged. Job stayers, 4.5%, unchanged from October. And job changers up 6.4%. That's down 0.2. Perhaps that's an indication of a slightly of a weak job market. Andrew?
Indication of a weak job market. It is a weak job market. You heard it. Large employers, companies with 500 or more workers, they did not add jobs. They lost 18,000, net negative. The South lost 10,000 jobs. The West lost 11,000 jobs. Manufacturing has lost jobs every single month since March of 2024. That is almost 2 years straight. ADP chief economist said it plainly. Quote, "We have seen a continuous and dramatic slowdown in job creation for the past 3 years." But here's the nuance. Wage growth held at 4.5% for people who kept their jobs. So if you have a job and you have leverage, the money is still there. I want you guys to type 22,000 in the chat if that number concerns you. Type it in the chat. Now, quick update on the jobs data that we talked about earlier this week. The official January jobs report from the Bureau of Labor Statistics has been delayed to February the 11th, okay, because of the government shutdown. JOLTS data also delayed. Workers still do not have fresh employment numbers, while CEOs have real-time dashboards. Now, let me give you the stat that reframes everything that we are seeing. Check this out. Okay. Resume.org found that 59% of companies frame their layoffs as AI driven because, quote, it plays better with stakeholders than saying the real reason is financial constraints. 59%. Let that sit. They are not blaming AI because AI did it. They are blaming AI because AI sounds strategic to the board. It sounds like innovation. It sounds like we are doing big things inside the company. It sounds like we are on the leading edge. It sounds like the future. It sounds better than saying we aren't growing, or we overhired during the pandemic and now the math does not work anymore. And here's the other side of that coin. 1.2 million jobs were cut in 2025, but AI was explicitly cited in fewer than 5% of the actual layoff filings. So what is really happening? The real drivers are rate pressure, margin discipline, overhiring from 2020 through 2022. Companies got too big during the pandemic. Now they are correcting. But here's the key. AI may not always be the cause, but AI sets the new productivity bar, and that bar justifies staying lean. Even when AI is not the cause and in the press release, it is in the boardroom conversations about whether to rehire or not. The macro picture is clear. This is not a recession. This is not a boom. This is a split. Revenue growing, profits growing, hiring flat. Companies are using AI to grow without adding people. That is the reality. That is the new reality. And your positioning has to account for it. Now, let me show you where the opportunity is. Because in the middle of this split, there is a crystal clear path forward. Okay? I want you guys to stay with me on this segment. So here's what we know. $500 billion in AI spending. 22,000 jobs added. Record profits without record hiring. That sounds bad. But only if you do not know where to look. Let me show you where that 500 billion actually goes. And more importantly, what it means for your next move. If you are looking to make a move, okay? $500 billion in AI infrastructure. The spending does not just live in the cloud. The spending builds real things in real places, real workers. Okay? Look at all that. Data centers, they need construction crews. Cooling systems need HVAC technicians. Power grids need electricians. Server rooms need operations teams. Cloud platforms need engineers. And here is something that most people miss. 75% of Americans now agree that hands-on skills and practical experience matter more than formal degrees. 78% say the stigma around trade and blue-collar work is declining. Oh, people are finally waking up. Data center technician is one of the LinkedIn's fastest growing roles for 2026. That is not a software job. That is a physical infrastructure job created directly by $500 billion in spending. Now, let me give you a story that flips this narrative. Uber reported earnings on yesterday. Revenue up 20% to $14.4 billion. Record free cash flow, 200 million monthly active users. And they announced that they are expanding autonomous vehicle rides to 15 cities by the end of 2026. But here's a data point that surprised me when I read this, and I need you to hear it. In cities where Uber launched autonomous vehicle rides, human driver demand actually increased. Let me say that again. They added robots and they needed more humans. The technology is growing the overall market, not just replacing drivers. This is not a zero-sum game. CEO Dara Khosrowshahi, and I know I'm butchering his name, but I'm going to pronounce it the way that I can read it. Okay. He said autonomous vehicles will, quote, fundamentally amplify the strengths of our existing platform. Amplify, not replace. That matters, because the story is not always AI taking your job. The story is not always AI takes jobs. Sometimes the story is AI grows the market and creates new types of work. I want you guys to type signal if you see that pattern. Record revenue, record profits, record efficiency, but not record hiring. The money is flowing. You just need to know where it is. Okay? Type signal in the chat. Now, Business Insider published something today that I want to share with you. They laid out a framework that every person watching needs to understand. I thought it was good. I'm like, all right, I'm gonna share this with the ladder climbers this morning. You know, I live on Business Insider. Here's the article if you want to see it. 5 ways to AI proof your job by Anna Altchek. I know Anna because Anna interviewed me for my Business Insider article. She's a great young lady and she knows what she's talking about. She does great work. Every row in the economy falls into one of 3 buckets. Bucket 1, full automation. Your work is predictable, repetitive, does not require complex judgment. If that is your job, you are highly vulnerable. Bucket 2, augmentation. Some parts of your job will be automated, but not all. AI helps you do more, faster, better. Most people fall in this bucket. Bucket 3, transformation. Your role changes completely. New skills required. But the opportunity on the other side is bigger than what you had before. The World Economic Forum estimates 92 million workers could be displaced by 2030. But displacement is not the destiny. It is a signal to move. And that brings me to something that I built for you all. The 2026 Career Protection Playbook. I've been doing this show every weekday morning since July of 2025, breaking down the data, showing you the stories, giving you the strategies. And I keep hearing the same question. How do I actually start? So I put it all together. The 2026 Career Protection Playbook. Business intelligence translated into career strategy. Here's what is inside. How to know your risk zone for AI automation based on the 3 bucket framework that we just talked about. Are you in the full automation? Are you in the augmentation? Are you in transformation? The playbook itself shows you how to find it. The 5 skills that actually matter in 2026. Not a list of 50 things, 5. The 5 that the data says employers are paying for right now. It also includes a 30-day quick start action plan, day by day, what to do, what to learn, what to apply for. So there's no guessing. And it also includes a weekend action plan with 5 specific moves, 5 things that you can do this Saturday and Sunday to start positioning yourself. It also includes the Daily Climb newsletter, delivered straight to your inbox Monday through Friday at 11:30 a.m. Central. Everything that we cover on this show, the data, the stories, the strategies, straight to your inbox. The professionals who survive 2026 are not waiting for permission. They are building career insurance right now. The playbook is free. The link is in the description of this live stream, of this video. Go and grab it. Go and download it right now, especially if you are new to the show. Now, if you want to go even deeper, the Patreon, where Big Suggs live, where the Life of Cam lives, where Danny lives, is where we break all of it down. We got the full certification roadmaps, the salary benchmarks by row and region, positioning frameworks that are working right now. Patreon.com/Black Heights. Link is in the description. Okay. Now, let me bring it to what you should actually do with all this information that I'm sharing with you. Stay with me on this segment. Okay. We've covered the data. We have covered the case studies. We have covered the macro. We have covered where the money is going. Now, let me give you the playbook, because knowing the data is not enough. You have to take action. You have to move. Okay. Here's how I want you to think about all this information. Okay. There are 3 lanes, and you need to figure out which one you are in. Lane 1, you work at a platform company, Alphabet, Amazon, Microsoft, Oracle, some private equity platform company. One of the companies building AI infrastructure. If that is you, stay, skill up, get certified. Get certified on your own company's AI tools. Google Cloud is growing 48%. AWS is expected to accelerate tonight. You are on the right side. Just deepen your advantage. Lane 2, your company's product can be replicated by AI, SaaS, legal tech, content platforms, vertical software. JP Morgan wrote this week that software stocks are, quote, not just guilty until proven innocent, but being sentenced before trial. That's what JP Morgan said. That pressure does not stop at the stock price. It will eventually reach your desk. And if that is you, start your exit plan. Okay. I'm not telling you to make a job switch or anything like that. I'm just giving you the signal. Start your exit plan, not next month, not 2 years from now, this week. Target platform companies, target AI infrastructure, target implementation roles. That's if you are looking to change jobs. That's all. Lane 3, you are in a non-revenue generating role anywhere in any industry. Workday, they just told you exactly what happens to non-revenue generating. 400 people gone. If you cannot prove your return on investment in one sentence, your role is vulnerable. Document your revenue impact. Move towards revenue-facing positions. And there is a fourth path. There is a fourth path that I want to mention. Healthcare. Okay. Eli Lilly just became the first pharmaceutical company worth $1 trillion. Zepbound, sales are up 123%. They are building a $3.5 billion facility. They are hiring in manufacturing, clinical research, regulatory affairs, supply chain. If you have a chemistry degree or chemistry experience, biology experience, manufacturing experience, supply chain experience, healthcare operations experience, this is your window. Pharma is hiring while tech is cutting. Now here's your weekend action plan. Check your emergency fund. 6 months. I'm telling you, start building up. Given the speed of these changes, 6 months. Send 5 networking messages. Not next week, this weekend. It's the beginning of the year. People are still saying Happy New Year. People are still talking about budgets. People are still talking about people. Send 5 messages to former colleagues, people in your industry, people at companies that you want to be at. Submit 3 applications. I would even say 5. 3 to 5 applications. Target AI infrastructure, cloud, healthcare, data center operations. Start one AI certification track. Google Cloud Professional, AWS Machine Learning, Azure AI Engineer. Pick one, start it, and audit your role. Full automation, augmentation, or transformation. Which bucket are you in? Okay. Top action in the chat if you are going to make at least one move this week. One course, one certification you're looking into, one application, one networking messages, or one networking message. Type 1 in the chat if you're going to make a move this weekend. I know many of you guys are going to type 1 in the chat because you're going to be on a phone call with me Saturday morning, 7 a.m. Central. Okay? That's what this community is about. Getting up and doing the work. The Patreon community is where we go deeper every single week. Which AI tools are out there? What goals do we have? What are we working towards? Where are the jobs? Who has an interview coming up? What certs are worth the investment? How to position your experience for roles that are actually growing? Patreon.com/Black Heights. Link is in the description. And let me bring it home. Okay? We covered a whole heck of a lot today. Alphabet, $180 billion signal. Eli Lilly versus Novo Nordisk. The Workday and Washington Post cuts. The ADP number. The 59% reality. Where the money is going. In the 3 lanes. Let me give you the 3 things to remember from today's show. Takeaway number 1. The split is real. Alphabet grew revenue 18% and profits 30% while committing $180 billion to AI. The ADP report showed that the economy added just 22,000 jobs. The money is flowing into machines and infrastructure, not headcount. Follow the capital expenditure to find the opportunity. Takeaway number 2, same industry, opposite outcomes. Eli Lilly hit $1 trillion. Novo Nordisk lost $50 billion. Same market, same day. The difference was positioning. One took advantage of U.S. prices, wasn't building any facilities here, and wasn't building any manufacturing here, wasn't diversifying. Well, the other, they invested in manufacturing. They invested in pipeline diversity. They invested in policy resilience. Where you sit within your industry matters just as much as which industry that you are in. Takeaway number 3, the 59% reality. 59% of companies frame layoffs as AI driven because it sounds better to stakeholders. AI was cited in fewer than 5% of actual layoff filings. But AI sets the productivity bar that justifies staying lean. The cause does not matter if the outcome is the same. Audit your role. Build your skills. move towards the growth side of the split. Okay. Now, tonight, Amazon reports earnings after the market closes. Expected revenue over $211 billion. AWS expected at $34.9 billion. If AWS accelerates above 22% growth, the AI infrastructure boom is officially confirmed across the board. You're talking about Alphabet, you're talking about Amazon, and you're talking about Microsoft all spending into strength. If guidance disappoints, we could see another sell-off like we saw with Microsoft. Either way, it changes the map. And I will be there, and I will be here at 7:25 a.m. on Friday to tell you exactly what it means for your paycheck. Okay? Now, if you cannot watch this show live every single morning, you cannot catch it, make sure you are subscribed to the newsletter every weekday, Monday through Friday. You get a full recap of everything that we've covered, the data, the stories, the strategies delivered straight into your inbox. I send the email out at 11:30 a.m. Central. Okay? It's automated. And if this show is helping you see the market clearly, hit the subscribe button. If you are new here, this is your first time, and you haven't hit the subscribe button yet, hit the subscribe button. We are building something here every weekday morning, 7 a.m. Central. The data, the strategy, the positioning, helping you to grow, helping us to grow this community. Newsletter link is in the description of this live stream, of this broadcast, Monday through Friday, the full breakdown into your inbox at 11:30 a.m. Central. Okay? Make sure you like this video. Do it right now. Subscribe to the channel if you haven't subscribed yet, because we don't want you to unsubscribe. And share it with someone who needs to hear this today. Someone in SaaS, someone in media, someone wondering if their role is safe. Share it. The economy is splitting. Record revenue on one side, record efficiency on the other. Alphabet is spending $180 billion on AI infrastructure. Eli Lilly hit $1 trillion in market value. Novo Nordisk lost $50 billion. 300 journalists walked out of the Washington Post. And the whole country added 22,000 jobs. Here's the thing, guys. What does crisis do? Crisis creates opportunity. The $500 billion in AI spending, it builds real things in real places with real workers. Data centers need people. Cloud platforms need people. Healthcare needs people. The question is not whether the opportunity exists. The question is whether you are positioning yourself for it. Audit your role. Pick your lane. Make your move. Your move matters. Keep climbing. Okay? I'm going to see you guys on tomorrow. It's always good to see you guys. Big Suggs, always good to see you. Jason, good to see you. It's always good to see you. Life of Cam, it's always good to see you. 2009 Hollywood. I think, as a matter of fact, 2009 Hollywood, you're new here. ARDS7KC, good to see you, man. Jason says almost 2K subscribers. Ain't that right? We moving, man. We moving, Jason. We're going to be there, brother. SL Gentis, good to see you for the first time. Topaz, good to see you. Aquarius Vibe, good to see you. You guys go out there and crush your Thursday. Big day. Big day. I got a lot of work to do today. It started with this show. I got the energy to do it too. Go out there and crush your day. And we will see you all on tomorrow. Take care, guys. Bye-bye.